The Federal Reserve began its scheduled two-day meeting today, and though it is a virtual certainty that policymakers will hold steady, the central bank and Wall Street aren't necessarily on the same page when it comes to their outlooks. Steve Liesman explains the disconnect.
The CNBC Fed survey shows markets are definitively not looking for a rate hike as the Fed meets this week. 100% of those surveyed see the Fed standing pat. 94% do say the next move by the Fed will be a hike rather than a cut, but they're looking for a later, looser Fed. The 48 respondents, they include economists, fund managers, and strategists from across the industry. They now see the next rate hike coming in August. That's 2 months later than the prior survey. So here are the expectations for the actual funds rate. You can see the blue line is the CNBC Fed survey, the average, 0.8%. 1.4% for 2017, 2.1% for 2018, and 2.7% for the long run. You can see this is closer, but still below where the median of the Federal Open Market Committee officials are. So the biggest gap there being in 2018, nearly a percentage point for where the Fed thinks rates will be and where the market thinks rates will be. Looking at the change in where people think the stock market's going to be, a nice rebound here. This is the January swoon we had with this concern about recession. You can see we've recovered where we were back in December, but the bad news in this chart is they think the market's fully valued right now. Just looking for a 1% increase for the rest of this year. More of the hopes and dreams for the market are in 2017, where they're looking for a 7% increase from the current level. All of this comes among a better but not wonderful economic outlook. Take a look at the chance of recession. It had climbed pretty steadily after the January concerns over the economy. Now it's been inching back down. Just a 21% probability of a recession seen in the next 12 months. But take a look at GDP. This is the views on GDP over the past 12 months here. We thought in December 2014, 2.8% was the view for the 2016 GDP. That has come steadily down as we have increased pessimism over the economy. And now, for the first time, the average is 1.95%, the first time below 2% on the outlook for 2016 growth. For 2017, it's up a little bit better, 2.2%, but not hitting anywhere near that 3% that people were hoping for. For Nightly Business Report, I'm Steve Liesman.